Hello, I'm about to do the session 7 assignment and let me share my screen real quick. Okay. Okay, so the assignment overview for this session 7 says determine the cost of equity for three companies with varying risk profiles using the capital asset pricing model or CAPM as an As an analyst for a venture capital firm, you must calculate required returns for investment, evaluation, and provide strategic recommendations for cost of capital management. The analysis occurs in a rising internet rate environment with compressed technology valuations. And so here are some of the companies and their profiles. So for company A, it's Cloud Tech. It's a software startup. It's a beta of 1.8, capital structure of 100% equity financed. It's in the software as a service industry. It's a high growth startup competing with established firms. That's the stage it's at. And then company B is a regional bank corporation. Its beta is at zero point 0.9. The structure is a traditional banking operation. It's in the financial services industry and the stage that's it's in a mature, stable, but slow growth. And company C is a green energy utilities, has a beta zero point 0.5. The capital structure is a regulated utility, and it's in the utilities industry. The stage is that it's mature with predictable cash flows. And if we look that into Gemini, um, here is the here is the a little graph that shows the three companies, the calculations and the cost of equity for each. And if we go back here, we can see these datas and go back here. If we do the calculations for each of these, for Cloud Tech, cost of equity would be 15.30%. For regional bank, it'll be 9.90%. And for green energy, it'd be 7.50%. Um, and here's the security market line and risk visualization. So for the green energy, it would be it was 0.5, excuse me, and then that's 7.50, which we got here. The 9.90 for regional bank and the cloud tech 15.30%. So to interpret that um little what do you want to call this table? Cloud tech 15.30%. It sits far right on the SSM. It has high systematic risk and the highest required return due to its high growth, it's competitive, and it's fully equity financed startup status. And for green energy, it sits far left. It reflects its stability and low risk, typical of regulated utilities. And the high spread and required returns, 15.30% versus a 7.50%, highlights the significant impact of systematic risk beta on valuation, especially in a higher interest rate environment. All the way down here. Okay. And then, so for the explanation of the beta differences, the beta for the cloud tech is very high and aggressive. For the regional banks, very defensive. It's neutral. It's in the medium range. And the green energy is low. It's highly defensive. Um, so I just explained all these. And also, if we go down for the relationship between the business risk and financial risk, business risk is high for cloud tech and low for green energy, and financial risk is zero for cloud tech, but significant for regional bank and green energy, which use substantial debt. However, for green energy, stable business risk allows it to safely take on high financial leverage without drastically increasing its overall systematic risk, and the beta remains low. So for the cost of capital management strategies for cloud tech, the 15.30% makes funding expensive and significantly reduces the net present value of future projects, and the strategy should focus on reducing the high beta. So the strategy that should be used is shift the revenue model focused on securing long-term sticky enterprise contracts over volatile small business subscriptions, diversified customer base, and achieve scale or profitability. Excuse me, profitability. Strategy two should be trade-offs of financial leverage. Introduce strategic debt. Um, the benefit is that debt is cheaper than equity. The trade-off is that higher leverage increases financial risks. For a volatile startup like CloudTech, too much debt could lead to default, potentially increasing its beta. And the strategy three, investor communication strategies, is transparency on retention, highlighting excellent net revenue retention figures, demonstrates the stability and resilience of future cash flows, countering the perception of high startup risk, and focus on total addressable market and MOATs. Clearly articulate the long-term competitive advantages to justify the current high valuation and high beta. And here's a little table of the company recession, the change from base case. Here's a table of the assumption, limitation, criticism. Here's a little comparison. So, so just to sum everything up here, beta is king, and the calculation shows beta is the primary differentiator for required returns. However, the qualitative analysis proves that understanding why a company has a high or low, excuse me, beta is more valuable than the number itself. And monetary policy dominance. The scenario analysis highlighted that while systematic risk differentiates the companies, the market-wide factors set by the Federal Reserve and MRP control the overall level of required returns, proving that macroeconomic policy often trumps micro level risk differences and model limitations. It's CAPM, while the language of finance is sufficient for a complex startup like CloudTech, high cost of equity demands further refinement using multiple factor models and relative valuation techniques to provide a complete picture to the venture capital firm. And here's a little code that was created. Shows the libraries, the parameters, company data, three different things. This is the cloud tech, regional banking, green energy utilities, the calculation, the data frame, the security market line. All this.